Welcome to the deep dive. There's always that tension, right? When you're looking at a really intense options scenario.
Oh, absolutely.
Like imagine a trader holding an Apple 200 call, just 2 days before earnings, or someone selling SPY puts right in the middle of a huge VIX spike. The anxiety is it's palpable.
Yeah, you're just staring at the screen, sweating.
Right. But today, for you listening, our mission for this deep dive is a little different. We're decoding a stack of financial notes and trading guides to figure out how to spot a dying company before the rest of the market even has a clue.
Spotting the slow motion train wreck, basically.
Exactly. We're going to look at how sophisticated traders use options to play these life or death corporate moments. And I want to jump right into a real world scenario from the sources.
Let's do it.
So let's talk about WeWork. This is prior to their 2023 bankruptcy. From the outside, massive brand recognition, those gorgeous office spaces in major cities.
Free kombucha on tap.
Right, the whole aura of success. But walk us through what the traders were actually seeing when they popped the hood.
Well, what they saw was an absolutely terrifying rate of cash consumption. I mean, WeWork was burning through $1.6 billion every single quarter.
Oh, wow.
Yeah. If you break that down, they were losing over $17 million every single day.
Wait, $17 million a day? Just in losses.
This to keep the lights on and the doors open. Yeah.
But I mean, a company that size, they must have had a huge war chest to pull from, right? Like a massive bank account.
They did have cash, sure, but it was only about $2.5 billion left in the bank. Right. So anyone doing basic division could see their runway. The literal time they had left to survive before hitting zero, it was under 2 quarters.
Less than 6 months of life left.
Exactly. And that undeniable math, that's where the options traders stepped in. The ones who spotted this disconnect between public perception and the balance sheet, they started placing bets using long-dated options.
Our notes show they were buying puts, right? Betting the stock would collapse.
Yeah, and those trades, they eventually became what the industry calls 10-baggers.
Which means they returned 10 times the original investment.
Right. The stock completely crashed.
Yeah.
It went from an implied value of like over $50 down to under $2.
Jeez.
To the general public, it was a sudden shock. But to the traders looking at the liquidity math, it was a perfectly predictable collapse.
10 times your money just by reading the writing on the wall. So today, we're going to walk you through the exact step-by-step logic of how a trader spots this setup.
The math behind the trades.
Exactly. And crucially, we're going to look at when this perfectly logical, foolproof strategy completely blows up in a trader's face.
Because the stock market loves to throw a completely irrational curveball just when you think you're a genius.
Always. So let's start with the foundation. To understand why that WeWork put trade worked so well, we have to understand the core metric, liquidity.
Right, which means wrapping our heads around cash burn and runway.
Yeah, and I like to visualize this using a really simple real-world analogy. So imagine you're driving a car across a massive, scorching desert.
Okay, I'm picturing it.
The cash your company has in the bank is the gas currently in your tank. And the cash burn rate, that's your miles per gallon.
Makes sense.
Right. So if you're driving a massive, super inefficient SUV with a tiny gas tank, you're simply not going to make it to the next oasis.
You're going to get stranded. And that analogy translates perfectly to the corporate dashboard.
Yeah.
Runway is just the calculation of how many months you can keep driving at your current speed before the engine dies.
And our sources give us a really specific scorecard for this, right? Like warning levels.
They do. So if a company has over 24 months of runway, they're in the comfortable zone. You don't need to worry about them breaking down.
Plenty of gas.
Exactly. Now, when that drops to between 12 and 24 months, it's still adequate, but management needs to start mapping out where the next gas station is.
Okay, but traders looking for short opportunities aren't targeting companies with 2 years of gas.
No. The alarm bells start ringing at the 6 to 12-month mark. That's highly concerning because it means the company absolutely must raise capital soon.
And raising money when you're desperate is always expensive.
Always. But the sweet spot for a short seller is anything under 6 months. That is the critical zone. Imminent dilution or straight-up bankruptcy, like WeWork.
Okay, I want to push back on this on behalf of the listener for a second. Let's look at it from an average retail investor's perspective.
Sure.
If I'm driving that car in the desert and my gas tank is low, but my trunk is packed full of, I don't know, expensive gold watches, rare paintings, maybe a literal brick of gold.
Right, you have stuff.
Yeah, I'm still rich. So if a company has a massive amount of physical assets, office buildings, heavy construction equipment, whatever, Why are they suddenly facing bankruptcy just because their actual cash account is low?
Because having assets on paper does not mean you have liquidity in reality. And this is a huge distinction in the sources, the difference between the current ratio and the quick ratio.
Okay, break those down for us.
So the current ratio looks at all your short-term assets divided by your short-term liabilities. Basically, everything you own that could theoretically be sold within a year, divided by the bills you have to pay within a year.
Got it. And a ratio under 1.0 means you owe more than you have.
Exactly, which is dangerous.
But there's a flaw in that, isn't there? Like, you can't easily pay your corporate electric bill by handing the power company a stack of unsold winter coats from your warehouse.
No, you definitely cannot. And that is exactly why sophisticated analysts rely on the quick ratio instead. It's notoriously called the acid test.
The acid test. I love that term.
It sounds intense because it is. The quick ratio violently strips out your inventory. It completely ignores the winter coats, the raw steel, the empty office chairs.
Right, the stuff you can't sell fast.
Right. It only looks at the cash you actually have in the bank, plus your receivables, which is money other people owe you that is actively clearing into your accounts right now.
So it's only the things you can turn into actual usable dollars by, like, next Tuesday, divided by what you owe right now.
Exactly. That's the acid test. And for the quick ratio, any number under 0.5 is the extreme danger zone.
Under 0.5. Wow.
Yeah. If you have a massive warehouse of inventory, but a quick ratio of 0.2, you are effectively walking dead. The bank is going to force you into bankruptcy anyway because you can't pay them today.
Which brings up a very natural pivot to the people who hold all the power here, the lenders.
Oh, yeah, the banks.
Because running out of gas in the desert is scary on its own, but it's way worse when the repo man is actively chasing your car across the sand, threatening to dismantle your engine while you're still driving.
That is a stressful image.
Right. And that leads us to the concepts of debt walls and covenants. Let's start with covenants.
So covenants are basically the invisible tripwires of corporate finance. They're strict, legally binding promises a company makes to a bank when they borrow money.
I always think of a covenant like a really strict parent co-signing a car loan for a teenager.
Oh, that's a good way to look at it.
The parent says, look, I'll sign the paperwork so you get the car, but here are the rules. You must keep a 3.0 GPA, you have to keep your weekend job, and no speeding tickets.
Right.
If the kid breaks any of those rules, the parent doesn't just get mad, they actively take the keys away.
And in the corporate world, taking the keys away is devastating. These covenants require companies to maintain certain financial grades.
Like what? What kind of rules do they set?
They might be forced to maintain a minimum cash balance of, say, $50 million at all times, or they might be legally restricted from taking on any more debt.
But what happens when the financial grades slip? What does the corporate parent actually do?
They pull the ultimate leverage. If a covenant is breached, the lenders can instantly hike interest rates to punishing levels.
Yikes.
Or, more terrifyingly, they can trigger a clause that makes the entire multi-million-dollar loan immediately due in full. Tomorrow.
Just pay us right now.
Yep. And if the company can't pay it, the lenders force them to liquidate assets for pennies on the dollar, which completely wipes out the shareholders.
The teenager doesn't just lose the car. The car is sold for scrap metal.
Exactly.
That sets the stage perfectly for the debt wall, which sounds ominous.
Because it is. A debt wall is what happens when staggering amounts of a company's debt mature, meaning they come due to be paid off in full, all at the exact same time.
So it's the difference between owing $50 million this year, $50 million next year, and then suddenly staring down a $500 million balloon payment the year after?
Exactly. And when you combine a short runway with a looming debt wall, you get one of the most reliable signals in the stock market.
Okay, here is a crucial counterintuitive insight from the guides we read. When that wall is approaching, the company's stock usually crashes before the actual bankruptcy or emergency capital raise is announced.
Yep, it drops early.
But why? Like, to a casual observer, shouldn't the market wait for the official press release? Why does the stock crater before the bad news hits the wire?
Because institutional investors are forward-looking. When a company with no cash hits a debt wall, they only have terrible options. The most common is an emergency equity raise.
Meaning they suddenly issue and sell millions of new shares of stock to the public just to get cash,
Right.
which instantly dilutes the value of every single share that already exists. It's the
Right.
classic pizza analogy, right? You had a pizza cut into 8 slices.
Yep.
The company desperately cuts it into 16 slices. You don't magically have more pizza. You just own a significantly smaller, less valuable piece of the pie.
And that dilution destroys shareholder value overnight. Plus, doing an emergency raise proves to the market that the underlying business model is actively failing.
They're bleeding cash with no way to stop it.
Exactly. And to spot this panic early, traders look at interest coverage. You take the company's earnings and divide it by their interest expenses.
So how much money they make versus how much they owe just in pure interest on their loans.
Right. An interest coverage ratio of 1.0 means you make exactly enough to pay the interest, with literally 0 pennies left over for the actual business.
Which sounds awful.
It is. Our sources flag anything below 1.5 as the danger zone. At 1.5, a CFO is sweating bullets. A single bad month puts them under 1.0 and they default.
Okay, so we've diagnosed the patient. We know the vital signs. Runway under 12 months, debt walls, failing the acid test, interest coverage dropping.
The writing is on the wall.
But identifying the problem is only half the battle, right? How does a trader actually step into the market and structure a play to profit from this?
Well, the sources outline a few ways, but they highly emphasize a specific option strategy, the put spread. This is how pros bet against a company while mathematically defining their worst-case scenario.
Okay, options jargon can get really dense. Let's translate this into something we all deal with, like buying an insurance policy.
I like that. Let's hear it.
So if you buy a premium car insurance policy that covers absolutely everything from the very first dollar of damage, your monthly payment is going to be astronomical. So expensive.
Right. So to lower that upfront cost, you make compromises. You accept a much higher deductible, or you agree to a strict cap on the maximum payout.
Yeah.
By legally capping how much you can potentially make if the car gets totaled, the insurance company significantly lowers the price you pay today.
That is precisely what a put spread accomplishes. Let's walk through a step-by-step hypothetical from the guides.
Okay, I'm ready.
Imagine a stock trading at $50 a share. You've seen the debt wall. The balance sheet is a disaster.
All right, I'm looking at my screen. Stock is $50. I want to bet against it.
Your first step is buying the $50 put option. This is an at-the-money put. Let's say the premium, the upfront cost, is $4 per share.
Okay, so I pay $4, and I own the legal right to sell the stock at $50 no matter how far it drops.
Right, if it drops to $10, you still sell it for $50.
Sounds great, but paying $4 a share feels kind of expensive.
It is. Because if you only bought that put, the stock has to drop all the way to $46 just for you to break even. So to lower my costs, I need to make a compromise.
Exactly. You simultaneously sell an out-of-the-money put. You look down the chain and sell a put at the $40 strike price.
Okay.
By selling this, you take on a legal obligation to buy the stock at $40 if it drops that far. And for taking that risk, the market pays you a premium of $2.
Let me make sure I have the math locked in. I paid $4 out of pocket to buy the right to sell at $50.
Yep.
But in the exact same transaction, I collected $2 back by selling the $40 put. So my net cost is just $2 a share.
You've cut your upfront cost in half. Now your break-even is $48 instead of $46.
The $50 strike minus the $2 I paid. Got it. But what happens if the stock completely craters like WeWork did?
This is where the cap comes in. Your max profit happens if the stock hits 40 or lower. Between the 50 put you own and the 40 put you sold, you capture that entire $10 difference.
But I paid $2 to enter the trade.
Right. So your absolute maximum profit is $8 per share, even if the stock goes to zero.
Okay, wait. You're losing me on the fundamental logic here.
How so?
If I've done all this research, and I know for a mathematical fact that this company is a dumpster fire destined for bankruptcy, why am I willingly capping my profit at $8? Why not just buy that original 50 put, write it all the way down to zero, and walk away with $46 per share?
It's the most tempting thought process in trading.
Yeah.
But it ignores reality. You cap your upside to defend your capital today.
Defend it from what?
By selling that 40 put, you reduced your risk from $4 down to $2. And defining your risk is essential because dying companies do not die on a convenient schedule.
The fundamentals dictate bankruptcy, but the timeline is a mystery.
Exactly. And while you wait, you're fighting against time decay.
Which brings up a crucial concept. Imagine buying a massive block of ice in the middle of July, right? You leave it sitting on your porch. Every single day, a little bit of that ice melts away. If you wait too long, you're just staring at a puddle. In the options world, that melting ice is time decay. Every single day you hold an option, it loses premium value simply because the expiration date is getting closer.
Time decay is the silent killer. If you just buy the 50 put, you're holding a melting block of ice. But when you build a put spread, when you sell that 40 put to someone else, you are forcing them to pay you for their own melting block of ice.
Oh, that's clever. The money you make daily from their time decay offsets what you're losing on yours.
Exactly. It's a structural defense mechanism. It insulates you.
Yeah.
But the biggest reason you must rigidly define your risk is because the stock market is not a textbook.
Right. When does this beautifully calculated strategy completely blow up in a trader's face?
When the market completely ignores reality. And the absolute perfect case study from our sources is AMC theaters during the pandemic.
Oh, wow. AMC, I remember that.
Think about that environment. Theaters globally were shuttered. Revenues effectively went to zero. They only had enough cash to last a few months.
Based on every metric we've discussed today, catastrophic cash burn, no runway, debt walls bankruptcy looked certain.
Absolutely certain. Put buyers were aggressively loading up. It looked like the easiest trade of the decade.
The math was flawless. And then the internet got involved.
A massive retail trading frenzy erupted. Millions of retail investors coordinated online and started buying AMC. Not because the business was good, but because they liked the stock and wanted to squeeze the short sellers.
A meme stock rally.
Yes. It completely detached the stock price from reality. The price soared to astronomical heights.
And what did AMC's management do when they saw their stock going to the moon while their bank accounts were empty?
They executed a masterclass in corporate survival. They capitalized on the skyrocketing price to issue and sell massive amounts of new shares directly into the hype.
They magically raised, what, $1.2 billion?
$1.2 billion in cold, hard cash.
They were dying of thirst in the desert, and a viral internet trend magically airdropped a tanker truck of premium gasoline right onto their hood.
Exactly. They survived entirely because of internet hype. And all those sophisticated traders holding puts, they got completely decimated. Their options expired worthless.
That is wild.
The profound lesson is that ticker popularity and pure retail sentiment can temporarily override balance sheet fundamentals. The market can remain irrational much longer than you can remain solvent.
So if meme rallies can destroy a logical trade, how do traders protect themselves?
Well, that requires avoiding the value trap. This is the final major warning from our sources.
Right. Think about the last time you saw a famous company's ticker drop to $3 or $4. Your brain anchors to the past, right?
Yeah.
You think, man, I remember when this was a $100 stock. It's dropped 80%. It's a bargain. Let's buy some calls.
Buying those calls is a very dangerous game. A stock that has already dropped 80% can effortlessly drop another 80%.
It's true.
If you're looking at a $5 stock, but their quick ratio is 0, their cash burn is immense, and they have a debt wall on Friday. That stock isn't cheap. It's just accurately priced on its way to 0.
It can drop from $5 to 50 cents in the blink of an eye. Just because a stock is trading for pocket change doesn't mean it has intrinsic value.
Exactly. You wouldn't buy a car without an engine just because the dealership offered a 50% discount. The price tag is irrelevant if the vehicle cannot move.
So true. Okay, let's step back and synthesize the journey we've just taken today. We started by looking at corporate survival through cash burn and runway.
Figuring out how much gas is in the tank.
Right. Then we explored the hidden dangers of the balance sheet. Why physical inventory is useless when that quick ratio drops below 0.5.
The acid test.
We talked about the terror of debt walls and broken covenants where lenders take the keys away. Then we broke down how professionals use put spreads to define their risk and fight time decay.
The car insurance analogy.
Exactly. And finally, we saw how the unpredictable nature of meme rallies can turn a surefire bankruptcy into a logic-defying miracle.
Liquidity problems create highly predictable trading patterns, but a solid option strategy must always define its risk because market sentiment can briefly outlast a company's fundamentals.
Perfect takeaway. And it leaves you with a really fascinating paradigm shift to ponder. If a fundamentally broken company's survival now hinges on their ability to spark a viral internet rally rather than actually fixing their business, how does that permanently change the way we evaluate true runway in the modern stock market?
Something to think about.
Definitely. Keep exploring the numbers, keep questioning the consensus, and we'll catch you on the next deep dive.